So yeah, welcome. We are talking economics today. Economics as it concerns real estate. So, specific to us as investors, what do we need to know? What do we not need to know? What kind of clutter do we want to just get rid of and not be worrying about? And, we're going to kind of do a kind of a comparison countrywide. It's stuff that we can apply to any market. Doesn't matter what market we're in. That's whether it's, we're looking at what province we want to look at or what city, down into what town, even what neighborhood this stuff can apply to. All of it comes down to what are we looking at in real estate? How are these things going to affect us as investors? And, why should we care? So that's what we're going to talk about today.
The thing about it too is that not only do we want to know that if we're investing in a particular region, we want to know all of these things that back up why we're buying in that region. We want to know that for ourselves.
Yeah.
But even more importantly, if we're looking for joint venture partners, if we're looking for people to invest with us, this is the type of information that when we relay it to people, they go, wow, yeah, okay, this person does know what they're talking about. This person has done the research. This person is knowledgeable when it comes to the real estate market. And so when we find these certain things that we're going to talk about today in a particular market, it's awesome. That's what we should be looking for.
We're going to talk about three things today. Now, economics wise, oh my goodness, there's so many different indicators that we can look at to see, what's happening. Some of them are going to apply in all markets and some of them are not going to apply at all. We have to pick and choose. We are the masters of our own domain. So as investors, we have to decide what is it that's going to affect my market? What's important in my area? Now, if you were to try to find good, strong economic indicators of every single thing, it like come together with a perfect storm and find the perfect spot to invest, you'll probably sit there never investing because there is no perfect place that has every indicator looking beautiful. However, there are some super strong indicators in most markets that we can look at as an overall. So economics, it's the idea of what's the prosperity of the area? How are people using their resources, their money? How is it going economically? And then therefore, that's going to affect us, right, as investors. I'm going to give you three today, okay, that we're going to talk about. Three things that can affect us as investors. There are so many, and you'll have to kind of start to educate yourself on them, but three really important ones. So now the obvious ones are jobs and GDP. Those ones are obvious. There's a whole lot more out there that you can find out on your own.
So when you say jobs, just to clarify, you mean an increase in jobs, right? So if there's a number of jobs coming to a market, you want me to grab your paper?
Yeah, please.
Okay. Or if there's a whole bunch of jobs leaving a market, those are the types of things that can affect real estate in that market.
Yeah, exactly. So jobs, but again, that's something you can look up and you can find out, high incomes. Of course we want high incomes. How's that going to affect housing prices? Of course, people can afford more money, or more house. Jobs is an easy one. That one we're going to leave to you to do your own research. We're going to talk about three that are a little bit less, maybe out there that people know about as much. So, Don Campbell, was a very big proponent of, and so we followed his advice when we first started investing on transportation changes. So when a change comes into an area, what will that do and how do we measure it, or can we measure it? So we're going to talk about that. So transportation changes, the Affordability Index. It's probably one of my favorites. It's one thing that I ran with hugely when we were talking to joint venture partners, and really it's an easy concept for people to understand. So it's a nice way to educate your partners, show them that you know your stuff, and still not get too complicated. So it's absolutely one of my favorites. And then immigration, so where people are moving into your province from another province, and then there's where people are moving into our country. What are the differences? How will that affect our real estate differently? Do we want that? Do we not want that for real estate? All of these things we're going to hit up.
We're going to talk about all of these different things that affect our real estate. So affect prices long term. They're going to affect our rents. So they're going to affect how much cash flow we're going to have in a property, or how much we'll be able to gain in equity over the years, the coming years, that sort of thing. So important economic indicators that drive real estate in a lot of cases.
So here's a caveat though. We want to put a caveat in right away. We did a lot of our buying based on economics, solely on economics. And as much as that's, it's good for us to know it. I had a background in economics already and in statistics. And so for me, that was just like, oh yeah, okay, I'm all in. I love this stuff. And it was great. However, there's these wild cards that affect real estate. And unfortunately, real estate is it's its own like moving beast. It's got its own living and breathing life. So there's wild cards that affect it. We're going to just kind of give you a few examples of those, just so you can see that although economic indicators are a great way for you to start looking at an area and deciding whether or not you want to continue your research there, it's also not a sure thing. We really want to emphasize that, because a lot of people will go in and say, well, the GDP is going to be great, so therefore we're good. But that's not actually how it turns out. So for example, in Alberta, we had a perfect storm of stuff happening in Alberta. And then a global change happened in oil pricing. Nothing to do with Alberta, but this whole movement of environmental stuff and Saudi Arabia fighting with so-and-so and bringing oil in, all this stuff, all these different things that we have no control over. And that changed things in Alberta. Another example, Vancouver. So, we talk about, we're going to talk a little bit about the Affordability Index, which is our house prices versus our incomes. Well, in Vancouver, it's like upside down practically. People can't afford it. However, it's continuing to go up. Why? Because there's a wild card. What's the wild card? You know what the wild card is, right? Foreign investment. Mm-hmm. That's a wild card. Nobody expected all of that major influx of money to come in.
So really, what's the point? The point is economics are a good indicator. They're an indicator. Exactly. They're not the end all be all.
Yeah.
We can follow them. We can learn the stats behind them. We can know where things are going to go, generally speaking. Yeah. But certain things that can happen in the world, like you're talking about, a certain Saudi Arabia or Venezuela or some of these high oil producing countries, for example, can end up getting into a war, or who knows what can happen. You talked earlier about 9/11 and how
9/11.
That affected in September 11th when that happened, how that affected real estate in a lot of different areas. And is that something that you can ever plan on happening?
Yeah.
Not really, but consumer confidence can go up or can go down. And so, definitely things that can affect real estate that you can't really plan on. Yeah. And that can happen, which is as good as the economics, as good as the numbers behind everything, there's little wild cards that can come along the way.
So here's our caveat, is that you can use this stuff for your own information in what you want to do with your investing. You can also share it with your joint venture partners and saying, listen, this is why I feel that this is a really good place to be investing our money right now. But at no point can you guarantee any of the economics, because for one, they can change, but for two, there are wild cards that can trump all of it. So this is good information, good learning, good things for you to find out, and they certainly do have merit. We're going to talk about some stats of why they have merit, but at the same time, can you now guarantee that this is a great place to your joint venture partners and tell them, oh yeah, I can definitely, we're investing here because of this, this, and this, and it's a sure thing because the numbers say it's not a sure thing. No. So there's your caveat, all right? Okay, guys, so let's jump into our first economic indicator that we're looking at, okay? Our very first one. I mentioned Don Campbell was huge in this when we were learning. So he talked about, so in our area, there was so we had our city core, and then we had a ring road that was going in around our city. And so as the interchanges opened, or were planned and proposed and then finalized, I guess, we knew that people would then be closer to work. So Don always says, people don't measure time or their distance to work in kilometers. They don't say, oh, so how far are you from work? Oh, 32.78 kilometers. That's not what they say. They say, oh, I'm 19 minutes or I'm an hour and a half. Mm-hmm. They talk about their distance
in time.
Mm-hmm. So when you have a transportation change, it comes into an area and can make that time shorter, then there is a great opportunity for us as investors. So some of the things that can happen, some of the different things like an LRT line, for example, or a light rail transit, GO train, whatever you call it in your area, A ring road, like we just talked about.
Certain freeways or certain, sometimes it's just an interchange that's put in. Maybe there's been a freeway there for a long time, but a new interchange is added.
Now you can access it quicker from a certain area.
Now those properties are closer to everything that is on that freeway. So again, we want to look at where are changes being made. Now the beauty of this, and this is the awesome part about transportation changes, is that municipalities and provinces usually have plans for these types of things many, many years in advance.
Like 10, 20 years in advance.
I can remember as a kid, actually, I remember my dad in his business had a big picture of the Edmonton area. And this was back in, well, it would have been late 80s. So mid to late 80s. And I remember seeing proposed ring road. It was on the map back in the late 80s, a proposed ring road around Edmonton. Now, it didn't get finished until what, like 2010, 2012, somewhere in there is when it actually finished. So, but the planning for it was so far in advance. So, those who maybe bought before it was finished or before those interchanges were finished got an extra bump in their real estate prices because they planned really, really well. Totally.
And let's talk about that bump. Okay. So there's so much controversy over, does it actually affect things? Does it not? So, the American Transport Association came up with a number and said that you will get 42% better sale price on your home if you are within a certain area of these new transportation changes. That's especially with an LRT line, let's say a light rail transit of some sort. So 42% better. Now that was out of a study that was done in Washington. However, it sounds a little bit high from what we saw and have seen in our own portfolios and what many people do. It's often, so I wrote down these, kind of figured out these numbers. So in Canada, I think it's more normal for us to see 20 to 30% more rent. Okay, 20 to 30% more rent. 15 to 20% more sale price. So when you go to sell, those are a little more common. 42%, that would be fantastic. But is that realistic? Might be a little bit optimistic for sure.
And it depends, of course. Like, for example, if it's an LRT, but the LRT only has 3 stops on it, and you're one of the 3 stops, well, are you going to get a 30% bump in a sale price? Well, no, because that LRT doesn't really go anywhere. But if that LRT now connects to a major network across a major city, and now you can go anywhere in the city quick, well, you're going to get a bigger bump in those locations. So these things all vary depending on, what you are close to, whether that's an interchange or a freeway or an LRT or whatever it might be. But what's the point? The point is if you're close to one of these things, if you own a property near one of these things, and then it's added, that transportation change is made, well, now you're going to get an extra bump over what that market is already doing on its own. So that whole entire market might be going up, let's say 5%. But if you're close to one of these changes in that market, well, you're going to have an extra bump over that 5%. And that's what we're talking about.
Perfect. So now people will say, okay, well, how close do I have to be? So, it's all depends on your area. And I'll give you a couple of examples. So, for example, if you are, let's say there's a new stop for a GO line or a train that's coming to your area, and it's going to make the commute that people would have from their area now to work, like in major workforce dense areas, so downtowns or maybe industrial parks, whatever it is for your area. And it's going to take their commute time from being, an hour and a half on the roads to now it's going to be a 30-minute train ride. How many more people are going to move out from that area now and be able to live a little further away than they would have before? And so those are the kinds of things that we watch for. Now, 300 meters is what they say. So 900 feet-ish, within a kilometer-ish is what they say makes the biggest difference. Okay, so within 300 meters. Now let me put a caveat on that. We were in, the first time it happened, we were in New York City. We parked in this parkade and we asked the guy, hey, we're going to this spot. Is it okay to, is it within walking distance? He's like, he wanted us to park there. He's like, oh yeah, walking distance. And then, we were like, oh, okay, how far is it? And he's like, oh, 30 minutes, 30 minutes. And we were like, whoa, like we're from Alberta. We drive everywhere. We don't walk anywhere. So we were like, that's really far. In Hong Kong, a lady, we were in a mall and trying to actually outside the mall, trying to get somewhere else to this other district. And I said, should we take the train, or is it within walking distance? Oh, you can go walk 30, 40 minutes. You get there fast. And I was like, 40 minutes is walking distance. So it depends on the area.
By the way.
I didn't have an accent. It depends on the area. What is common in that area. In Alberta, 10 or 12 minutes, I tell people I have some places that are within LRT, within that kilometer, but it's still like a 15, 20 minute walk. People aren't willing to do that. So what works in your area? Is it 300 different meters? Yeah. Or is it 100 meters? You have to decide what that is. So go walk it. Would this be reasonable for the culture of your area for people to want to do? If it would, can it make a difference? Absolutely. I can get more rent and I have very few vacancies, less turnover. People love staying in those places. When they do come vacant, they fill real quick. So there's a lot of benefits to being in those areas, but you're the one who has to determine what that is, because the stats that come out are not, you can't go by everyone's stats. Does that make sense to you guys? Even the doubling of a highway or the doubling of a normal road, just the doubling of it so that there's less congestion, that and more safety, that alone can make people, I know in the area that we invest in, there was just this normal road. It was just one lane each way. They doubled it, so there's 2 lanes coming in and out now. That little town that it connected to, which was only 10 minutes outside of the city, is absolutely booming, all in that area now, just because it's such a quicker, easier, safer little drive. Yes, the LRT in Ottawa, absolutely. That's been huge. There's been no LRT in Ottawa forever.
And it just opened within the last year, really, didn't it?
Yeah, huge difference. There's the Green Line, yes.
Sudbury Marley Drive extension.
Awesome, okay. Perfect. Awesome. So now you go to that extension, okay, where are people, if they want to get out from there and drive home or walk home, where would they be living? Where are those people going to be? There's the Green Line. There's the St. Catharines.
Lots of ideas coming up. Richmond Hill. We have some changes happening in the southeast part of Calgary. The Ring Road in Calgary.
Now, if you can get, which is what we did, because at the time there was both those changes. There was a Ring Road going around. So we were buying around the interchanges that were happening as they opened. We would buy them about a year ahead. Because once they start opening, people realize it, right? But we knew it ahead, so we bought ahead. And then also, there was LRT, light rail transit lines, going to some of those same areas. So we would buy in that quadrant, knowing that we would be able to hugely change how much we could ask and those kinds of things. So yeah, the Edmonton LRT, the Southwest Ring Road in Calgary, Jen. Yeah.
Awesome, guys. So awesome job for throwing some of these things in the feed, because you know what? It helps others to recognize this stuff. And it's one of those things that, maybe we see it all the time. We see these things happening. Maybe we're driving down the freeway and we're complaining about the traffic. And then we see them building something and construction is in our way and we're complaining about the extra time it's taken because of construction. But now maybe we're going to look at that and say, well, listen, that means that this is going to open up and it's going to be quicker to get from here to here. It's going to be quicker to go from there to there. And you know what? Look at that building over there. Look at those houses over there. Look at that townhouse complex over there that's really, really close and has excellent access. Those now we'll start seeing them a little bit differently, and we can start noticing that those are great spots to be looking to buy. Those are great spots to own before the changes actually are complete. Yeah. If we buy it before they're complete, then we're going to get that extra bump in our price that Tiffany was talking about.
So I was just going to mention this really cool study if you guys want to look it up. It was awesome when I looked it up way back when, and I was really into it. So this is such a definitive indicator. Again, indicator. So it's not that it says this is a guaranteed thing, but it indicates that there's some strength there for us as investors, is the Shepherd Station in Toronto. So when that opened in 2002, what's really interesting is actually before it opened, city planners, they planned on the fact that when they opened that station, the surrounding properties would go up in value. That value increase would translate to a tax increase on their property taxes. And therefore, they actually planned that into paying for the Shepherd Station. Go back and, I mean, it's been a while since I looked at it, but it's pretty cool that it is so definitive in some areas, so count-onable that even city planners had counted on that to pay for the cost of putting in these new stations. So
first thing to remember that we're talking about today, transportation changes. Look for them as you're driving around. Look for them in the news headlines that you hear.
What are they going to do?
What is being announced? What is planned or what is proposed that might come down the line? So these are the kind of the things that we want to start looking out for. So number one are transportation changes. Yeah. What's number two?
Number two is the Affordability Index. So again, this was one of my favorites.
Tiff talks about this one all the time.
Well, I love it. This is why, because it's so easy to explain and yet it makes so much sense. So when I worked in statistics, it was, one of those things that Alberta always was able to pride themselves on. And then it was starting to get out of control for a little while. And so what it is, I'll tell you about it. The median income, so pretty much average income, you could kind of say, median income versus housing prices. Now, in a balanced market, we want to see between 30 and 40%, let's say, 33 to 38%, they say. So that means that the average person is going to be making this much and paying 35-ish% of that amount toward home ownership costs. Okay? So let's say 35% is a balanced market.
And that's kind of one of the indicators that a bank uses to approve somebody on a mortgage. If they're for a personal residence, they're going to approve you based on, okay, they don't want 75% of your personal income going to pay this mortgage. They're going to say you can't afford that. So it has to be under that number, under the 40%, and usually somewhere in that 33, 35% is what is kind of considered a balanced market.
A balanced market, yeah. And it depends who you talk to, and different economists will say different things, but that's kind of your benchmark, okay? So incomes versus house prices is your affordability index, and a balanced market is, let's say, 35%. In Canada, the average person pays almost 52% of their income toward their housing costs. That's over what an economist would like to see in a balanced market. Okay, that's Canada-wide. That averages everything from St. John's, Newfoundland,
which is high,
to Vancouver. It's quite high. It's among the highest in the world, I believe. Vancouver, 84.7%. 84% of every dollar that you have is going toward your housing. On average, is going toward your housing. Now, remember when we talked about those little wild cards that can affect things? Now, the reason that is because incomes are decent in BC and in Vancouver. But what has happened is the house pricing, where the incomes and house pricing should be kind of following each other. Well, actually like this. So, no, incomes, house prime backward in this thing. Incomes here, house pricing here, 30%, and they usually go like this together, right? They raise. In Vancouver, what's happened is our incomes have stayed the same, but the house prices have really gone up. And so now there's that bigger gap. Again, there's that wild card. Foreign investors came in with billions of dollars and changed the whole scene. So can we rely on it 100%? No, but does it give us an indication of what's happening in a market? Absolutely.
Well, and this is where the whole talk of a bubble ends up coming up. You might have heard people say, when is the bubble going to burst? Or what is a real estate bubble? Well, a real estate bubble usually occurs when people can't afford the house prices in a specific region, when their income doesn't support where the house prices are. So that's where bubbles start to get created. And so
San Francisco, for example, back in the 90s, so San Francisco, everyone was going nuts in late 90s and in the tech bubble too hit, but it was, everyone was going crazy buying these houses and it was just getting expensive, but yet their incomes hadn't changed. Nothing was different for that area. And so that's where they start saying, that again, a wild card is that consumer confidence, it just got too much and the frenzy and emotions got involved and a bubble hit. So if you'd looked at the affordability index in San Francisco back in that time, I can't remember what it was, but it was like, 120% of people's incomes were going toward their housing, which again is not sustainable, right? Obviously not sustainable.
So you mentioned 51% for Canada.
Yeah, Vancouver's 84%. Calgary is 40%. So toward the higher end, but still within a normal market, okay? still so people can still afford the housing prices that there is. Edmonton is at 34.8%. Remember, perfectly balanced market is around that 35%. Edmonton's at 34.8. Toronto's at 66.1. Do we start to see that, and that this is, and you'll have to look up, I did actually mean to, but I forgot to, what exactly Toronto means. Is that the GTA or what is it, right? But each area, you can figure out the affordability index by finding out what their incomes are and finding out what their average house prices are. And even I can do that math, and I suck at math. So Ottawa, 40%, so nice and balanced in there too. Montreal, 44.5%. There's a whole, I just kind of got the summary. I did read the whole report, but I didn't print it. But it goes all the way through every single province. What's happening in the major cities in the areas. Where are the incomes versus the house prices?
So one of the things that we would want to look for when it comes to an affordability index is we would want to look for one where people can afford for the real estate to increase.
Right.
That's what we want to look for. If we're going to buy for a long period of time, we want to buy and hold, let's say, and we want to own a piece of property for 7, 10, whatever many years. We want the ability for the house price to be able to increase and people to still be able to afford it.
Yeah.
That's the point of looking for the affordability index.
Once they can't afford it, we know that things are going to have to start going backwards. Right?
And this is the thing, and this is one thing I wanted to clarify just really briefly, because we talked about a bubble, and a bubble scares people. And then we mentioned Vancouver at 84% and Toronto at 66%. Does that mean that those markets are ready to crash? Well, what it means is the people that live there can't necessarily support it. But this comes back to the caveat that we were talking about earlier. The caveat is there's other things that can also, aside from economics, other things that can drive a market.
Wild card.
And they're happening in Vancouver and they're happening in Toronto.
So what does that tell us though? Let's say we're looking at Vancouver and we're like, holy smokes, 84%, that sucks now. Does it? Okay, so here's the deal. So when something hits in an area, let's say that there's people coming into, Metro Vancouver with, all this 84%, of their incomes. That's what they're going to have to do. Where are those people going to go? Those people start moving out further. Those people then move out further and further and further. So now, if we see that this is happening, does that mean that that's areas off our list? It doesn't have to, but do we then, again, as an indicator, look at it and go, oh, okay, so what's happening outside of there? Where are those people going to go? Where are the people going to go that are, have been there for 10 years and are realizing like, wow, everything's outpacing us? Well, maybe if we go out by half an hour or an hour out of town, and we can do that now, we're no longer young and, vibrantly eating out and stuff. We now have kids and we don't mind the yard and all that stuff. Plus, hey, there's a new GO train line or there's a new SkyTrain coming to that area. Perfect. I'll just take that into work. Now where are those spots? Where are those people going? Because they're going somewhere. We saw a lot of people go out to the island from Vancouver. Victoria really changed.
Or even deeper into the Fraser Valley.
Abbotsford,
and that's where those transportation changes are. And so this is where you start combining some of these things. We start to see, okay, it might be too expensive for an investor to buy in Vancouver. So let's start going outside of Vancouver, a little bit up the Fraser Valley, and where are some transportation changes happening along that way? And this can apply to any city. This can apply to any market that we're talking about. It can apply to Edmonton or Toronto or you name it. The point is let's just find out what the affordability index is. If it's wacko, which Vancouver and Toronto really are.
Why is it wacko?
That means that the towns around those areas are going to start seeing an increase in population because people they can't afford to live where they are, so they're going to start looking elsewhere.
Find out what the affordability index is in your area. If you don't know it, again, you can come up with it. It's an easy one to come up with. It's housing prices versus incomes. So find out the average income, find out the average housing price, and see the percentage change in it, and figure out whether or not that's an indicator that's strong, not strong, and what you need to do with that information. Okay, so the next one is immigration. Immigration that comes into our country, into Canada from other countries. There's also then intra-provincial migration, where we move. People that are already in Canada are moving from province to province. Two different indicators and two different things that happen based on both of those things.
Flows of people.
Mm-hmm. Yeah. Yes. Okay. So I find it super interesting, and amazingly, I just have nothing but respect. Did you know that the average person that is new to Canada, their net worth will outwin a Canadian's net worth within less than 3 years? I'm going to give you a minute to think about that. So they're new to Canada. Oftentimes they come with nothing, even refugees, okay, who come with nothing. And they will have a stronger net worth than the average Canadian within 3 years. Why is that? For one, they are willing to do the things that we're not willing to do. They live together, they share home, they house hack, they do, all those things. For two, they save their money. And for three, they won't get into debt. Are these great renters for us? Absolutely. I'll tell you what, yeah, isn't that crazy? Those stats, you guys, it's unreal. That's right. Work ethic, no pride about it. They're absolutely willing to do the things that we are not. They are thrilled to have a job. Doesn't matter what it is. They don't get into debt. That's a big part of it is they don't get into debt. When you're looking at in migration, where are people coming into? Is there an area? Is there a city? Are there certain cities? Absolutely. Is Toronto one of them? Absolutely. Are there certain parts of that city? Absolutely. Do we go into those areas and find where are people landing? 80+% of people that land in an area will stay there for 5 or so years. So that's a huge thing that tells us, listen, they're landing, they're staying within 5 years. Here's another stat for you. They buy a house in about 3 to 4 years. They buy a property. It's not necessarily a big home like we will buy as our first home, but it's a starter home. It's a condo, it's a semi-detached. So what are we buying? And where are we buying it? Are we buying semi-detached thinking, you know what, we want to be out of the market in 5 years and there's a major influx right now of people coming into our country and they'll be ready to buy in about that time and this kind of property is going to be, really under demand?
So now we can start thinking about these things to identify where are good locations to rent a property, to own a property and rent it out. Also good locations for having an exit strategy down the road. And that's the second part that you were referring to.
Yeah.
That, we're going to have a whole bunch of people looking for this type of property in 3, 4, 5, 6, 7 years from now, because that's about how long they end up renting, and then they want to start buying something, right? So, so not only an exit strategy, but also where are the renters going to want to live? Just
to tell a quick little story, we have these condos. So we bought a bunch of units in this one complex a few years back. That was quite rough, and we had to do a lot of turning around, had to sit on the board, had to do all kinds of stuff to, make it a better property, but we had bought enough units in it. We bought about 40-ish ourselves, and 60 we were involved with us, where we had other investors buy in out of a 200-unit complex. So we were able to kind of hold a lot of weight in changing it. However, it's still not, it's not what it was, but it's still not the best place in the whole wide world. But guess what? We lipstick and rouged them. We made them nice places to live. They're not fancy, but they're decent places to live. And guess what? At the end of the day, that's what we focus on now is newcomers, because there's two choices in our area. They either go to one kind of inner city neighborhood where they can get, access to transportation and buses because they don't have vehicles, and the food and the groceries that they want and that they're used to. Or there's this other area. We happen to be real close by that. This area is a lot safer. You can walk at night. They're not fancy, but over here is a lot less safe. So we've taken these properties now, and guess what? That's our tenant profile that we hit on. Every time there's a vacancy, we go straight to, there's a newcomer center that's not too far. Call them up and tell them, hey, listen, we have these places. It's within a 5-minute walking of you guys, because they also teach them English, show them how to bank, that sort of thing. And, I just think of my dad when he first came to this country, and if he had had these opportunities and these things that happen, how much easier things could have been for him. That's our tenant profile now. And we have fantastic, kind, hardworking, amazing people that live in these places and appreciate a safe, clean home to be in. So absolutely, can you use this as an investor? Absolutely. You can find out what those areas are and you can, help them. We give them awesome places and they're safe for their kids. And it helps us because you know what? It's not it would attract a rougher person, truthfully, if we hadn't been able to turn that complex around a little bit.
Okay,
Perfect.
so recap. Today we're talking about economics. Today we're talking about how certain things we can research, we can learn, we can get to know better. The more we know it, not only is it going to help us in our real estate investments, but it's going to help us attract partners because we can explain it to others as to why we're buying in a specific region. So there's lots of different factors. There's a million different factors. We only had time today to talk about 3 of them. Number 1, we talked about transportation changes, where major transportation changes are happening, whether that's highways, freeways, trains, bus stations, whatever it might be. Look for
Even
changes happening that is going to shorten people's commute, shorten time to get to certain amenities. Okay, so number 1, we talked about transportation changes. Number 2, the affordability index. Look for areas where people can afford the house prices, and they can afford for those house prices to go up. And that will create a strong long-term investment opportunity. So affordability index is a number that we want to know for wherever we're buying. What is it in that area? Yeah. Number 3, immigration. So that's how many people are coming to the area. Are people leaving and abandoning that area, or are people coming and moving into that area? Is the population going up, or is the population going down? Yeah. And those are the things we want to look for. So can
I just want to jump in too. For example, there's some logging towns, and this has happened in mining towns, and where, people would be like, oh, there's, real estate is on sale. It's, down so cheap, blah, 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 in this certain area because the mine just shut down. Or, logging industry, for example, right now in BC is going through some changes. So things have changed and the mills are shutting down. Oh, so it's on sale. It's on sale for sure, but are people going to live there? Are they going to rent there, or is everyone leaving? So that's what you want to look for. It's not just in migration, it's population changes, period, that, make that difference. So thank you for making that point.
One other story on that is I've heard, I don't know how many times, and somebody says to me, oh, I'm thinking of buying in this small little town in the middle of nowhere because I can buy a house for $10,000 or $50,000 or whatever it might be. It's super, super, super cheap. Okay, that might be good, but just because it's cheap doesn't mean it's a good investment. Right. Doesn't mean it's going to go up in value. Doesn't mean that you're going to be able to rent or cash flow.
Right.
So we want to look as to why is it cheap, and is population increasing? Is it easy to get to? Transportation changes. And what is the affordability index? Is there any jobs around that particular town? So those are things we want to keep our eye out for.
Where do we find these kinds of things? I mean, obviously the internet is crazy. There's so much information out there. So whether you're looking at a province, all the provinces have their own stats sites. You can look at the province, you can look at the city, you can look at small towns. Lots of them will have stuff online. It's usually to attract business or attract investment. To tell you a funny story, okay, one more thing I'll say. Economic development officers. So these guys are put in place. So, there's whole departments if you're in a city where there's an economic development department. But even in small towns, there's usually an officer. So you can contact them and kind of say, hey, listen, I'm an investor. I'm looking to buy property, rental properties. I'd love to know, what kind of stats you have on, what are market rents, or what's the vacancy rate of the area, or are there any, industry jobs, like who's the major employers in the area, all that kind of stuff. That's what the economic development officer is there for. I'll tell you a story. I've talked to more of them than I can count, because again, I love this stuff and kind of deep dived into it for a while there for a few years, and I would call them all the time. And I met with one from this small town, and he literally was like, oh yeah, you're crazy for wanting in this town. What a dump. I've lived here for many years and it's garbage. And he was like crazy going on about how the old people that run this town, they don't want any change and all this stuff. And I was like, wow, he's supposed to be selling the town. And he definitely sold me on not going into that town, which was very wise because the atmosphere that they had there was not conducive to investors. They were actually, don't want basement suites, and they were really rough on investors for quite a few years. Changed some of the bylaws to be against investing. So glad that we didn't actually jump in on those. But the economic development officer, he or she is the person that should know all that stuff and that you can get in touch with. So, and then of course, Google. Google is amazing everywhere. Get lots of good information. So that's our training this week. Jobs and GDP, those are huge economic indicators. You guys should all know what those are, but there's a lot of information out there on those, so you can look that stuff up yourself and self-teach. But oh my goodness, there's retail sales. How does retail sales, what is that? It's how much people are spending on stuff. What does that have to do with anything at all?
That's another one of your favorites.
It is a favorite. So I'll tell about the lipstick effect. I don't know if you've heard about it, and it's highly debatable, but it's an actual, like, they actually track sales of lipstick. And what it tells us is consumer confidence. It tells us, are people feeling good about the economy or not? And here's the theory behind it, is that when, for example, for women, when they are feeling confident about the economy, they may, splurge on higher priced items to spoil themselves with. But when they're not feeling confident about the economy, they still want something nice or something to pick me up, and they will go and they will buy perfume or they will buy lipstick. But it's called the lipstick effect. Look it up. It's highly debatable, but there's a lot of people that actually do believe in it and follow it. And even among economists, when I worked with nothing but economists, it was a thing that a lot of them actually said, no, absolutely. And that's one of those wild cards, consumer confidence. But what does retail sales tell us? It tells us, you know what? People are buying luxury cars and expensive trucks, and they're buying new vehicles. So what does that tell you is that they feel confident in the economy. When does that reflect? 6 months to a year later, that confidence often transfers to real estate because they're feeling confident about the economy. Now, what happens the opposite way? When they're not buying new vehicles and those higher priced items, that shows that there's scarcity and they're afraid. And so where does that reflect? Again, we're going to see that change in real estate, or at least not an increase in real estate within 6 months to a year. So watching retail sales can be really insightful in an area, especially often it's by province. You'll find that one, not by city or town.
The one thing too that I just wanted to mention that is economic related and that we want to be careful to look out for, because a lot of people get caught up by looking at what real estate has done in the past. Mm-hmm. And so they'll look at, okay, well, MLS sales have gone up, in the last year, it's gone up 10%. Well, that doesn't mean that it's going to go up 10% the next year. And so just remember that all the stats that come out when it comes to real estate, vast majority of them are what has already happened. And sometimes that's what happened 6 months ago.
Or even a year.
Or even a year ago. So those are delayed stats. So just be careful. We don't watch, okay, well, real estate has been up in the past year. What is going to ensure that it goes up next year? Well, that's the stuff we've been talking about today. That's because jobs are being created. That's because population is increasing. That's because there's room for the house price to go up because people can afford it. That's because maybe transportation changes are being made and governments are investing money in that area as well. So all of these types of things we want to look for more than just real estate stats, because those are past stats. So just keep that in mind too. Here's the tie-in to everything that we talked about tonight, is if we are looking for partners, if we are looking for people to invest with us, these are the types of things that we need to know. So these are the things we want to research, so that when somebody says, why are you buying there? Our answer is not, well, because it went up 5% last year. Our answer is not because I live there. Our answer is not because I can do renovations there. Our answer should be, well, because population is increasing, because jobs are increasing, because of the Affordability Index, because of the transportation changes. We should know these different things because of the retail sales that are happening there and that they're going up and people are confident. These are the things that we want to be able to relay to our potential partners. And then when we do that, here's the key. When we do that, people are going to say, yeah, I don't have the time or the interest to be looking this up on my own, so I'm going to just invest with this guy or this girl, because they do have the time, they do have the interest, they do know what they're talking about, and they can lead me down this path. And so that's a key to finding joint venture partners. So
there is a caution too, is that, we don't want to fire hose. And so how many of these things do you choose? I could put together a crazy amount of information on my market, but I won't do that because it will be too much information. I will choose one or two things we need to choose one or two. Let's say, I'm just going to give Calgary as an example. If we were to look at, incomes in Calgary, they're among the highest in the country. Absolutely. They're incredible. We look at the affordability. That's really good. If we look at GDP or in-migration, those aren't so strong. So we have to look at and weigh in what is strong in our market, how is that going to affect things, and can we explain it? Don't get into this stuff until you can explain it. If you can explain it, great. But if you don't know it yourself, better to just not even mention it until you do know it yourself. Thank you guys. Thanks for your time. Thanks for joining us.
Okay.
Cheers,
See you guys.